When people ask why the stock market hasn't crashed yet, what they're really expressing is a sense that the numbers no longer line up with lived experience. Wages feel stretched, housing feels unaffordable, debt levels feel high, and yet equity markets continue to reach new highs. Historically, those conditions didn't coexist for very long. Something gave way, so the confusion is understandable. But I think the more useful question isn't whether the market should have crashed by now, it's whether we're still using the right mental model to understand how today's economic system transmits stress, absorbs shocks, and reallocates risk. For most of the 20th century, markets were relatively direct reflections of underlying economic activity. Capital was scarcer, information moved slowly, and policy intervention was limited in both scale and speed. When profits fell, asset prices followed. When confidence broke, liquidity vanished. Crashes were brutal, but they were also comparatively clean resets. That system no longer exists. Today's markets are embedded in a much larger, more engineered structure. Capital moves automatically through retirement systems. Central banks intervene preemptively, not reactively. Governments spend countercyclically at unprecedented scale. Technology compresses response times from months to minutes, and ownership of financial assets is far more concentrated than most people realize. In that environment, markets don't respond to stress the way they used to. They respond to policy expectations, liquidity conditions, and forward looking narratives about technology and productivity. That doesn't mean risk has disappeared. It means risk has been redistributed across time, across institutions, and across populations. So when we look at high valuations and say this can't last, we may be right in principle, but wrong about the mechanism. The system is now designed to delay visible breakdowns, even if that delay comes with costs, mispriced assets, growing inequality, and a widening gap between financial performance and economic well being. Understanding this distinction matters because if you're waiting for the market to behave the way it did in 2000 or 2008, you may miss what's actually happening. The absence of a crash isn't proof of health, but neither is it proof of imminent collapse. It's a signal that the system has changed and that we need to think more carefully about how stability, risk, and progress really work at scale. To understand why markets behave the way they do today, it helps to step back and look at how capital actually flows through the system. And most people still imagine markets as places where individual investors make deliberate choices based on valuations, earnings, and risk. That picture is incomplete. A growing share of capital now moves automatically, continuously, and with very little reference to short term economic conditions. Retirement systems are a good example. Trillions of dollars are funneled into equities every month through 100Ks, pension funds, and index based products. These flows don't pause because valuations are high or because consumer confidence dips. They're governed by payroll cycles, contribution rules, and default allocations. From the market's perspective, this capital is remarkably stable. It doesn't panic easily, and it doesn't wait for better prices. At the same time, institutional investors operate under constraints that favor staying invested. Large funds are benchmarked against indices, and underperforming those indices for extended periods is often more damaging to a manager's career than participating in an overvalued market that continues rising. That incentive structure encourages conformity, not contrarian behavior. When everyone knows valuations are stretched, but no one can afford to step aside alone, prices can remain elevated far longer than traditional models would predict. Policy plays an equally important role. Central banks today are not passive observers. They actively shape expectations. Even when rates are relatively high by recent standards, markets price assets based on where they believe policy is heading, not where it is now. The implicit assumption that authorities will step in during periods of severe stress has become embedded in asset prices. That assumption may or may not hold indefinitely, but as long as it does, it dampens fear driven selling. Technology amplifies all of this. Algorithmic trading, passive investing, and instantaneous information dissemination compress feedback loops. Markets adjust quickly to new data, but they also reinforce prevailing narratives with extraordinary speed. And the dominant story is that liquidity will remain abundant and long term growth will be driven by technology. Capital aligns itself accordingly. Dissenting views struggle to gain traction unless they're accompanied by a clear, immediate catalyst. Another structural shift is globalization. Many of the largest publicly traded companies are no longer tightly bound to the economic health of a single country. Their revenues are diversified across regions, currencies, and markets. Weakness in one area can be offset by strength in another. The diversification stabilizes earnings and, by extension, valuations, even when domestic conditions feel strained. All of this creates a system that is resilient in the short term, but increasingly abstracted from everyday economic signals. Layoffs, rising living costs, and stagnant real wages matter enormously to households, but their translation into market outcomes is indirect and delayed until those pressures materially affect aggregate earnings, liquidity, or policy expectations. Markets can continue to move higher. This doesn't mean fundamentals are irrelevant. It means fundamentals now operate through a more complex set of intermediaries. Capital markets have become less like thermometers and more like control systems, constantly adjusted, buffered, and recalibrated to avoid sharp discontinuities. The risk, of course, is that complexity can mask fragility. Systems designed to smooth volatility often concentrate it. Elsewhere, when stress finally exceeds the system's capacity to absorb it, adjustments can be abrupt. But as long as capital keeps flowing automatically, incentives reward staying invested, and policymakers signal support, markets can remain disconnected from underlying discomfort longer than most people expect. That's not irrational exuberance. It's a system behaving exactly as it was redesigned to behave. For most of modern financial history, valuation metrics served as useful early warning systems. When price to earnings ratios stretched too far above historical norms, returns tended to disappoint. When market capitalization grew faster than the underlying economy, corrections usually followed. These signals weren't perfect, but they were directionally reliable over time. What's changed isn't that valuations no longer matter, it's that they no longer tell us when something will happen. In earlier eras, high valuations constrained behavior. Capital was more expensive, leverage was harder to access, and crucially, policymakers were far less willing or able to intervene. When markets overshot fundamentals, there was little to stop gravity from reasserting itself quickly. Today, the relationship between valuation and correction has been stretched, sometimes by many years. One reason is interest rates, asset prices are fundamentally tied to discount rates. When the risk free rate is low, the present value of future earnings rises. Even if those earnings are far out in the future, over the past 2 decades, global interest rates have trended downward, interrupted only briefly by tightening cycles that markets increasingly view as temporary. That structural shift alone justifies higher valuation multiples than historical averages, even if it doesn't tend any valuation. Another factor is the growing importance of intangible assets. Traditional valuation models were built for an economy dominated by factories, inventory, and physical capital. Today, as most valuable companies derive much of their worth from software, data, networks, and intellectual property. These assets scale differently. They have high upfront costs and low marginal costs, which can produce long periods of reinvestment followed by rapid profit expansion. Markets are willing to pay more upfront for that optionality, especially when dominant platforms appear difficult to displace Inflation further complicates the picture. When prices rise across the economy, nominal revenues and earnings rise as well, even if real output doesn't. Valuation metrics based on nominal figures can look healthier than the underlying reality. Investors know this, but in an inflationary environment, the alternative holding cash that steadily loses purchasing power often feels worse. As a result, capital continues flowing into assets that can at least partially reprice with inflation. There's also a coordination problem. If valuations are high, but everyone believes policy support will persist, selling early carries opportunity costs. Markets don't correct because something is expensive. They correct because participants collectively decide that the risk of staying invested exceeds the risk of exiting. As long as liquidity remains ample and earnings declines are modest, that coordination failure persists. This is why metrics like market cap to GDP ratios or elevated PE multiples increasingly feel unsatisfying. They describe tension in the system, but they don't trigger resolution. They're indicators of vulnerability, not countdown clocks. The danger lies in misinterpreting the shift as proof that valuations are irrelevant. They still shape long term returns. Paying more today means accepting lower expected returns tomorrow. The difference is that the adjustment now happens through time rather than through immediate price collapses. Investors may not experience a dramatic crash, but they may endure a decade of underwhelming real returns instead. From a systems perspective, this is a trade-off policymakers have implicitly accepted. By smoothing volatility and preventing sharp collapses, the system tolerates prolonged mispricing. That can feel reassuring in the short run, but it also dulls the market's ability to signal scarcity, risk, and opportunity accurately. Valuations haven't failed. We've simply asked them to do a job they were never designed to do. Predict the timing of corrections in a world where policy, technology, and capital flows systematically delay them. One of the most important changes in modern markets is not technological, it's institutional. Over the past several decades, governments and central banks have steadily redefined their role in managing economic risk. The goal has been stability, fewer deep recessions, faster recoveries, and less systemic collapse. In many respects, that effort has succeeded, but it has also changed how risk behaves. Inflation is a central part of that story. Moderate inflation is often framed as a policy failure or a temporary inconvenience. In reality, it's also a powerful mechanism for reallocating risk. Inflation reduces the real value of existing debt and supports nominal revenue growth and makes hard assets more attractive relative to cash. Those effects benefit borrowers, asset holders, and institutions with pricing power, while quietly taxing savers and wage earners whose incomes adjust more slowly. When policymakers respond to economic slowdowns with aggressive spending and accommodative monetary policy, they aren't just stimulating demand. They're also signaling that sharp asset price deflation will be resisted. Markets internalize that signal. Investors come to expect intervention not as an exception, but as a baseline feature of the system. Over time, this expectation reshapes behavior. Interest rate policy illustrates this clearly. Even after periods of tightening, markets often treat higher rates as temporary deviations rather than durable regimes. That belief lowers long term discount rates in practice, supporting higher asset valuations today. The actual level of rates matters less than the perceived ceiling and the speed with which policy is expected to reverse. Under stress, fiscal policy reinforces the effect. Large, persistent deficits inject demand directly into the economy. That spending flows through companies' revenues, wages, and ultimately profits. From the perspective of financial markets, government spending acts as a stabilizing force for earnings. Even when private sector growth slows, the result is a system where corporate profits can remain resilient despite underlying fragility in household balance sheets. This doesn't mean policymakers are manipulating markets for their own sake. In many cases, they're responding rationally to political and social constraints. High unemployment, mass bankruptcies, and collapsing asset values carry enormous real world costs. Avoiding those outcomes is a legitimate objective. The challenge is that each intervention shifts incentives. Risk taking becomes more attractive when downside is perceived as limited. Leverage increases, capital concentrates in assets most likely to benefit from policy support. Over time, risk doesn't disappear, it migrates. And instead of frequent small corrections, the system becomes vulnerable to fewer but more consequential disruptions. Confidence becomes the key variable. As long as participants believe policy tools remain effective and politically viable, markets stay elevated. If that belief erodes, adjustments can be swift. There's also a distributional consequence. Policies that stabilize markets primarily protect those who own financial assets. Because ownership is highly concentrated, the benefits of stability accrue unevenly. Meanwhile, inflation erodes purchasing power for those without comparable assets, deepening the gap between financial indicators and lived economic experience. From a systems perspective, this is a classic trade off. Short term stability is purchased at the cost of long term distortion. The economy becomes more dependent on intervention, and markets become less informative as signals of underlying health. But given the alternatives, policymakers repeatedly choose intervention. Understanding this redesign of risk helps explain why markets can remain strong even as stress accumulates elsewhere. It's not that warning signs are being ignored, it's that the system has been intentionally structured to absorb them quietly, gradually, and unevenly. Technology has always reshaped markets, but what's different today is the speed and scale at which it concentrates economic returns. Digital systems reward size in a way industrial systems never could. Once a platform, network, or model is built, serving the next million users often costs very little. That dynamic changes how profits grow, how capital is allocated, and how markets price the future. This is especially visible in large technology firms. Their revenues are global, their margins are high, and their products often become embedded in daily life and business operations. When a company reaches that level of integration, it gains a kind of resilience that traditional businesses lacked. Demand doesn't fluctuate as sharply with economic cycles, and switching costs keep competitors at bay. From an investor's perspective, that stability justifies paying more for each dollar of earnings. Artificial intelligence accelerates this pattern. Large upfront investments in data, infrastructure, and talent create barriers to entry that only a handful of firms can overcome. Once those investments are made, the returns can scale rapidly. Markets are forward looking, so they price not just current earnings, but expected dominance. Whether those expectations are always correct is a separate question, but the logic behind them is understandable. Technology also changes labor dynamics. Productivity gains increasingly accrue to capital rather than wages. At least in the short to medium term, automation, software, and AI allow firms to grow output without proportionally growing headcount that supports profits even when employment growth slows. From the market's perspective, this decoupling of earnings from job creation reduces one of the traditional channels through which economic weakness translated into lower valuations. Scale matters here as well. Smaller firms often struggle with rising costs, tighter credit, and limited access to advanced technology. Larger firms absorb those pressures more easily. They negotiate better terms, attract top talent, and invest through downturns. Over time, that advantage compounds. Capital flows toward perceived winners, reinforcing their dominance and lifting index level performance, even if much of the broader economy feels stagnant. And this concentration has important second order effects. Stock market indices become increasingly driven by a narrow set of companies. When those firms perform well, Indices rise, masking weakness elsewhere. For households whose exposure to the market comes primarily through broad index funds, this can create the impression of widespread prosperity that doesn't match local realities. None of this implies that technology driven growth is illusory. Many of these companies deliver real value, improve productivity, and enable entirely new industries. The problem arises when expectations outrun implementation or when gains fail to diffuse broadly. Innovation that scales technically but not socially can inflate asset prices without raising overall economic resilience. From a systems perspective, technology amplifies both efficiency and inequality. It makes markets more robust at the top while leaving less room for error elsewhere. That asymmetry helps explain why markets can remain strong even as many people feel left behind. The returns are real, but they're concentrated, and they're increasingly detached from traditional economic signals. Understanding this helps clarify why market strength doesn't necessarily imply broad economic health. It reflects where value is being created, captured, and rewarded in a technology driven system. And it reminds us that long term stability depends not just on innovation itself, but on how widely its benefits are distributed and reinvested. When people talk about a stock market crash, they usually imagine a sudden, dramatic collapse, prices falling sharply, headlines turning panicked, confidence evaporating overnight. Those events still happen, but far less often than they used to. And that's not an accident. It's the result of deliberate choices about how much volatility societies are willing to tolerate. Over time, policymakers, institutions, and markets have converged on a shared preference. Avoid sharp downturns, even if that means accepting longer periods of imbalance. The logic is understandable. Sudden crashes destroy jobs, wipe out savings, and create political instability. Preventing them feels like responsible stewardship, but suppressing volatility doesn't eliminate risk, it changes its shape. In earlier systems, stress was released frequently through smaller corrections. Companies failed, assets repriced, and capital moved on. The costs were visible, but they were also contained. Today, the system is designed to absorb stress internally for as long as possible. Liquidity is injected, regulations are relaxed, and narratives emphasize resilience. The result is fewer visible breakdowns. But when limits are reached, the consequences can be broader. One reason these events are more costly is interconnectedness. Financial markets, supply chains, labor markets, and public finances are more tightly coupled than ever. A disruption in one area propagates quickly because balance sheets across the system tend to be optimized for efficiency rather than redundancy. There's less slack to absorb shocks once confidence breaks. Another factor is leverage. Even when households are cautious, leverage often accumulates at institutional levels through corporate borrowing, financial intermediaries, and governments themselves. Leverage magnifies returns during stable periods, which reinforces the belief that the system is working. But it also amplifies losses when conditions reverse, because much of this leverage is opaque or indirect. Risk appears lower than it actually is. There's also a psychological dimension. When markets remain elevated despite repeated warnings, participants adapt. High valuations become normal, intervention becomes expected. Over time, the memory of genuine downside fades. The complacency isn't irrational, it's learned behavior reinforced by experience, but it leaves the system vulnerable to surprises that don't fit the established pattern. Importantly, crashes today are less about fundamentals alone and more about confidence thresholds. Earnings can soften, employment can weaken, and debt can rise without triggering immediate collapse. What matters is whether participants believe the tools that have worked before will continue to work. Once that belief is questioned, whether due to political constraints, inflationary limits, or external shocks, adjustments can be swift. The cost of these adjustments is higher because more people and institutions are exposed. Asset ownership is concentrated, But retirement systems tie broad populations to market performance. Government finances are sensitive to asset prices through tax revenues and borrowing costs. When markets fall sharply, the feedback loops are stronger. From a systems perspective, this is a classic stability instability trade off. The very mechanisms that reduce the frequency of crashes increase their potential impact. By smoothing the path, the system allows imbalances to grow quietly when correction finally arrives. It has more ground to cover. None of this implies that a crash is inevitable or imminent. It does suggest that focusing solely on whether markets will fall misses the deeper issue. The real question is how resilient the system is when its assumptions are tested, and whether we've invested enough in buffers, transparency, and adaptability to absorb stress without cascading failure. Progress doesn't come from eliminating risk. It comes from understanding where it accumulates and designing systems that can fail safely rather than catastrophically. One reason the stock market can feel detached from reality is that not every part of the economy can be stabilized through financial engineering. And some systems are constrained by physical limits, human behavior, and affordability in ways that liquidity alone can't fix. Housing and labor are two of the most important examples. Start with housing. Unlike stocks, housing is both an asset and a necessity. You can delay investing in equities, you can't delay needing a place to live. That difference matters. Housing prices ultimately have to clear at levels people can afford with their incomes, creditworthiness, and life circumstances. When prices rise faster than wages for long enough, demand doesn't disappear, it becomes constrained. Transactions slow, mobility declines. Stress builds locally rather than expressing itself through a single national price collapse. Financial markets can absorb excess demand through fractional ownership, leverage, and global capital flows. Housing can you cannot buy half a home to live in, and that rigidity makes housing markets more sensitive to affordability than to liquidity. Even with investor participation and policy support, there are limits to how far prices can stretch before activity slows meaningfully. Labor markets operate under similar constraints. Employment isn't just a line item on a balance sheet. It's a relationship between people, skills, and organizations. While technology can increase productivity and reduce the need for certain roles, it can instantly redeploy displaced workers at scale. Training, mobility, and matching take time. When wage growth lags behind inflation, households adjust by cutting spending, taking on debt, or drawing down savings. Those adjustments don't immediately show up in corporate earnings, but they weaken the foundation over time. What makes this tension harder to read is that large firms, especially those driving index performance, are less exposed to these pressures. They have pricing power, global markets, and automation. Smaller firms and households bear more of the adjustment burden. That divergence allows aggregate indicators to look stable. While localized stress intensifies, this is where the limits of financialization become clear. You can stabilize asset prices through policy and capital flows, but you cannot fully insulate real systems from affordability constraints. Housing supply still depends on land use, construction capacity, and regulation. Labor outcomes still depend on education, health, and demographics. When these systems lag, they create friction that no amount of liquidity can fully resolve. From a long term perspective, this matters because sustainable growth depends on alignment. Productivity gains need to translate into wages. Asset appreciation needs to be supported by real income growth. When those links weaken, confidence becomes fragile, even if markets remain elevated. None of this guarantees a sudden reckoning. Adjustments can take years and vary by region, but it does explain why many people feel excluded from market gains and why optimism about asset prices doesn't always translate into optimism about the future. If there's a lesson here, it's that economic health can't be assessed through financial markets alone. Markets are powerful tools for allocating capital, but they're incomplete mirrors of societal well-being, ignoring the parts of the economy that cannot be smoothed, scaled, or abstracted risks, mistaking temporary stability for durable progress. Real resilience comes from investing in those foundational systems, housing, labor, education, so they can adapt alongside markets, not lag behind them. When systems change, the most costly mistake is applying old rules without updating the underlying assumptions. That's true for investors, but it's equally true for policymakers and institutions. The environment we're in today rewards patience, scale, and adaptability, but it also punishes overconfidence and rigid thinking. For long term investors, the implication isn't that markets are rigged or that participation is futile, it's that expected outcomes have shifted. High starting valuations reduce future returns, even if prices don't collapse. Volatility may be suppressed, but uncertainty hasn't gone away. That means risk management matters more than prediction, time horizon, liquidity needs, and diversification across real and financial assets become more important than trying to time entry and exit points. Institutions face a different challenge. Many are designed around assumptions of steady growth and predictable correlations. When markets are propped up by policy and driven by concentrated technology returns, those assumptions weaken. Pension funds, insurers, and endowments need to stress test not just price declines, but prolonged periods of low real returns combined with inflation. The risk isn't just a crash, it's erosion. For policymakers, the trade offs are sharper. Intervening to stabilize markets can prevent real harm in the short term, but repeated intervention without parallel investment in productivity, housing supply, workforce skills, and innovation diffusion creates dependency. Markets become more sensitive to policy signals and less responsive to fundamentals. Over time, the cost of maintaining stability rises. There's also a credibility dimension. Policy works best when expectations are anchored. If households and investors begin to doubt that inflation can be controlled or that public debt can be managed without continual monetary support, confidence becomes harder to sustain. That doesn't require dramatic failure. Gradual doubt can be enough. The common thread here is alignment. Financial systems, public policy, and real economic capacity need to move together. When they drift apart, stability becomes artificial. The goal isn't to engineer permanent market highs, it's to create conditions where innovation, investment, and opportunity reinforce each other sustainably. This is where long term thinking matters most. Systems optimized for short term calm often underinvest in resilience. Buffers are expensive, redundancy looks inefficient, but those features are what allow societies to absorb shocks without cascading failures. Progress has never come from eliminating cycles entirely. It comes from shortening recoveries, widening access to opportunity, and ensuring that growth is grounded in real productivity gains. Markets can play a powerful role in that process, but only if they're supported by institutions willing to look beyond the next quarter and invest in what actually scales. Understanding what markets can and cannot do is the first step toward designing policies and strategies that work in the world we actually live in, not the one we remember. If there's one takeaway from all of this, it's that markets today are neither broken nor invincible. They're operating within a system that has been deliberately reshaped to prioritize continuity over correction. That design choice carries benefits, but it also imposes responsibilities on investors, institutions, and policymakers alike. A pragmatic approach starts with humility. No single indicator, model, or narrative captures the full picture anymore. High valuations can persist, policy support can last longer than expected, technology can unlock real productivity gains, but not always on the timelines markets assume. Acting as if any one of these forces guarantees a particular outcome is a mistake. Instead, it's more useful to think in terms of scenarios rather than predictions. What happens if growth remains modest, but inflation stays elevated? What happens if productivity gains materialize unevenly? What happens if political constraints limit future interventions? Resilient strategies don't require guessing the future correctly, and they require being prepared for a range of plausible futures. That mindset applies beyond investing. For policymakers, the challenge is to recognize that stabilizing markets is not the same as strengthening the economy. Financial calm without progress and housing affordability. Education, health, and workforce skills is fragile. Over time, that fragility shows up as political polarization, declining trust, and reduced tolerance for the very interventions that markets depend on. The good news is that the tools to address this are well understood. Investing in innovation that diffuses broadly, not just to leading firms, but across sectors, raises productivity in a way that supports both wages and profits. Expanding housing supply reduces one of the most binding constraints on household stability. Strengthening education and training systems improves labor mobility, making technological change less disruptive and more inclusive. These are not ideological goals, they're practical ones. Systems work best when incentives align, when companies can grow because people can afford their products, when markets rise because productivity improves, and when policy support reinforces long term capacity rather than substituting for it. For individuals navigating this environment, the focus should be on robustness rather than optimization. Liquidity matters, flexibility matters, avoiding unnecessary leverage matters. So, does maintaining exposure to innovation and growth without assuming the past returns will automatically repeat? Markets will continue to surprise people who expect simple cause and effect relationships. That doesn't mean we should abandon analysis. It means we should widen it, looking not just at prices, but at the systems underneath them. Progress has always come from combining markets with institutions that learn, adapt, and invest for the long term. The question isn't whether the stock market will crash, it's whether we're using this period of apparent stability to build an economy that can thrive without constant intervention. If we do that well, markets don't need to be perfect. They just need to be connected to real value creation, shared opportunity, and solutions that actually scale.